Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're talking about bank mergers. Last week, it was reported that UBS and Credit Suisse were in the preliminary merger talks. These two banks are Switzerland's largest banks, and they're also long-standing competitors. If combined, they would become Europe's largest bank. Both banks have major financial interests, including interests in the U.S. A few years ago, two of the banks I deal with were involved in a merger, and to be fair, it was DNB First that acquired East River Bank. All of the East River Bank branches were converted to DNB First, except where there was too much overlap geographically. You would think that the impact of this would be minimal on customers, since we are customers of both banks. Of the two banks, DNB First was much more aggressive in their lending practices, and we definitely preferred DNB First over East River Bank for our commercial loans. But several of the senior executives from East River Bank were given responsibility for the loan committee at the parent company. The loan underwriting team from East River Bank was given responsibility for loan review, reporting to their former bosses, now in charge of the loan committee. Needless to say, the loan underwriting practices at DNB First changed and became much more conservative. Nearly every middle market bank in the industry is looking to either acquire another bank or be acquired, and it's likely that yours is no exception. Many banks see an acquisition or a merger as a chance to expand their reach or scale, yet a bank acquisition is not without its risks, particularly for the unprepared customers. So why would banks be merging in today's environment? Many banks were consolidated in the wake of 2008, not because they wanted to be acquired, but because the banking regulator forced the issue through their stress tests. If a bank's balance sheet was suspected of being weak, the regulator required an increase in the bank's equity in order to keep operating. Now, there's numerous banks in Europe where we will see this kind of consolidation in the next 18 months. And for the moment in the U.S., the Federal Reserve has agreed to guarantee the debt of the banks on a large scale. We don't really know how this is going to play out over the next couple of years. So what are some of the benefits of bank mergers? A bank merger helps your bank scale up more quickly and gain a large number of new customers instantly. Not only does an acquisition give your bank more capital to work with when it comes to lending and investments, but may also provide a broader geographic footprint in which to operate. That way, you achieve your growth goals much quicker. Acquisitions scale your bank more efficiently, not just in terms of efficiency ratio, but in terms of banking operations. For example, every bank has an infrastructure in place for compliance, for risk management, for accounting, and for general administration. And now that the two banks have become one, able to collapse those overheads into a single, smaller organization. Financially, a larger bank has a lower aggregate risk profile, since a large number of similar risk complementary loans decrease the overall institutional risk. In places where there's geographic overlap, the number of physical branches can be reduced with little to no loss of customer service. With the increase in online banking, the number of bank branch visits are dropping across the industry. Bank branches are a quiet and lonely place these days. Bank mergers and acquisitions allow some banks to fill out their product or technology gaps. Acquiring a smaller bank that offers a unique revenue model or financial product is sometimes easier than building that business in-house from scratch. And from a technology perspective, being acquired by a larger bank might allow your institution to upgrade its technology platform significantly. While not a factor on the balance sheet, every bank benefits from a merger or acquisition because of the increase of talent at the leadership level. An acquisition presents the possibility of bolstering the sales team, strengthening top management. And this human element should not be ignored. There is significant talent both at Credit Suisse First Boston and at UBS, both in the commercial bank and in the investment banking divisions. But there are a bunch of risks. Plenty of prospective bank mergers and acquisitions look only at the banks from a paper perspective without taking the people or the culture into account. And failure to assess cultural fit is one reason why many bank mergers fail altogether. Throughout the merger and acquisition process, there's got to be very tight communication and a commitment on both sides to the integration of the two banks. Integration risk is a major danger. In some cases, banking executives don't commit the time and resources necessary to bring the two banking platforms together. The resulting impact on customers can cause the newly merged bank to fail completely. A good example is Sabadell in Spain that bought TSB from Lloyds back in 2015. The UK parent bank provided a £450 million dowry fund to facilitate the 3-year integration process to move TSB's customers onto Sabadell's system. Once complete, the integration was expected to save £160 million a year, but by 2018, following the migration of 1.3 billion records, its customers reported a host of major glitches. Online banking customers were locked out of accounts, some saw other customers' accounts. The problems cost the chief executive his job, and £178 million in costs and compensation. When undergoing an M&A at a bank, some relationships with the bank's best customers are often put at risk. A single high-net-worth customer is worth 1,000 regular customers who signed up for the free checking account and the free toaster. And the final danger to consider during a bank merger is whether you can unify the risk and compliance culture of the two banks. Every financial institution handles compliance differently, but it's important that the two merging banks agree on their approach moving forward, and when two mismatched risk cultures clash during a bank merger, it negatively affects the profitability of the business if they haven't come to a proper working solution. As a real estate investor, you may be relying on your banking relationships to carry you through this difficult period. Don't discount the possibility that your bank might be acquired and that banking relationship might get severed overnight. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.